Hello there. In this video, we are going to look at CVP analysis. CVP stands for cost, volume, and profit. We are going to look at how different costs and the volume of your sales affects your operating profit. To begin with, we are going to see what operating profit or operating income is. To draw comparisons from financial accounting, we have a framework of a typical profit and loss statement or income statement as shown here. The top line is revenue or sales or turnover, okay? And we deduct the cost of goods sold from that to achieve our gross income, or you could also call it gross profit or gross earnings, because in financial accounting, income or earnings or profit, all these terms are used interchangeably. From gross income, you subtract your other operating expenses, okay, to reach your EBITDA. EBITDA stands for earnings before interest, taxes, and depreciation and amortization. So it's the profit you make before you deduct these four categories. From EBITDA, when you subtract your depreciation and amortization, you get your EBIT, which stands for earnings before interest and taxes. From EBIT, when you subtract your interest, the interest you pay on your debt outstanding, and your taxes, you finally get your net income. So now to define what operating income is, it's technically your EBIT, but only from your operations. The only difference is that EBIT might also include income generated from non-operational activities. For example, if you earned some interest on your cash balance, that interest income would be part of the EBIT, but not part of the operating income. Okay, operating income is income generated purely from your operations. So to summarize, when you deduct your expenses from your operations, from your revenue from operations, what is left is your operating income. Now we are going to expand this analysis a little bit. The first level of detail we get into is separating your costs into variable and fixed costs. Variable costs are costs that change with the level of production, whereas fixed costs are costs that do not change with the level of production. Okay. How do you obtain your revenue? You multiply the selling price of your product with the number of units you manage to sell. The total variable costs is the variable cost per unit multiplied by the number of units. Fixed costs, as we mentioned already, does not change with how many ever units you produce and sell. We're going to look at a new term here called contribution margin. What exactly is contribution margin? When you deduct your variable cost from your revenue, what you obtain is called the contribution margin. This can also be calculated at a per unit level. Okay, so you just find the revenue per unit, which is the selling price of that unit. Okay, you deduct from that the variable cost of one unit. You get the contribution margin per unit. Okay, why the name contribution margin? For every unit you produce and sell, okay, contribution margin is the amount of profit that is contributed to recovering your fixed costs. To understand this better, we are going to look at a numerical example here. Okay, let's consider a hypothetical situation. Let's assume that the total fixed cost in a production process is $50. Okay, the unit variable cost of producing each unit is $5. Let's say we can sell the final product for $15 per unit. Okay, so what's the contribution margin per unit here? Is basically the price of each unit. Okay, and you deduct from that the variable cost. Okay, so the contribution margin here is $10. What does this number 10 represent? For every unit you produce and sell, $10 is contributed towards recovering your fixed costs. As you can see, your fixed cost here is $50. So you might want to produce and sell several units to recover that $50. Contribution margin percentage is the ratio of contribution margin to revenue. Or you could find the contribution margin percentage using the numbers on a per unit basis like we have here, which is the contribution margin per unit over the price per unit. Okay, so the contribution margin percentage here is 66%. Now let's try to simulate a situation where we sell anything between 0 to 10 units, and we are going to see how this affects our contribution margin and our overall operating income. To calculate the revenue, you multiply the number of units sold with the selling price per unit. I'm going to block the cell so I can click and drag that. How do you get the total variable cost? You multiply the number of units sold with the variable cost per unit. Again, I'm going to block the cell with my variable cost in there so I can click and drag that. My contribution margin is basically my revenue minus the total variable cost. Okay, total fixed cost is going to remain fixed at 50. Again, block the cell. And my total costs overall is the sum of my total variable costs with the total fixed cost. Okay, my operating income is my revenue minus the total costs. Okay, now I'm going to click and drag the formula. Here you can see that the revenue increases with every unit you sell. Also, the total variable cost increases with every unit you sell. The fixed costs remain constant, okay, but the total costs keep increasing because the variable costs are increasing. And the operating income, you see here that it's negative until you sell a certain number of units, and beyond that it starts going up in a positive sense. To understand this better, let's try to create a chart. We'll include the revenue, we'll include the variable cost, we'll throw in the contribution margin as well. We'll have the total costs and the operating income in there. So the light blue line here represents the revenue. Okay, as you can see, when you sell nothing, your revenue is 0, but as you sell more and more, your revenue keeps increasing. Okay, then the orange line is your total variable cost. Again, it keeps increasing like the revenue, but at a slower rate because the variable cost is just 5 per unit. The gray line is the contribution margin, which is the difference between the revenue and total variable cost. The yellow line represents the total costs, okay, which includes also the $50 from the fixed cost, okay, and the dark blue line is the total operating income. As you can see, it's negative until a certain point, and beyond that it becomes positive. So when you sell exactly 5 units, you can see that your operating profit is 0. What does that mean? This firm should produce and sell 5 units in order to not make a loss or a profit. Okay, if they produce and sell less than 5 units, they make a loss. If they produce and sell more than 5 units, they make a profit. Okay, this 5 units is also known as break-even point. This is the level at which the firm breaks even. It doesn't lose any money or it doesn't make a profit. Now let's look at how to calculate the break-even point mathematically. Okay, we know that at break-even, your operating income should be 0. Okay, you don't make a loss or you don't make a profit. Okay, how do you calculate your operating income? You have your total revenue minus your total costs, and that has to be 0. Next, we can categorize your total costs into variable costs and fixed costs. Taking it one step further, you can split your revenue as the product of selling price and the number of units, and you can also split your total variable costs as the product of variable cost per unit and the total number of units. Earlier, we learned a new term for the difference between selling price and the variable cost per unit. It's known as the contribution margin per unit. Okay. Now, if we want to calculate the number of units we need to produce and sell at break even, okay, by using a bit of algebra, we bring the fixed cost to the other side and then divide the entire expression with contribution margin per unit to obtain the number of units to be produced and sold at break even, which is fixed costs over contribution margin per unit. Let's use the above example and try to calculate it using the formula we've derived here. Okay, total fixed costs in the case above was 50. Okay, I'm going to divide that by the contribution margin per unit. Okay, that tells me that I need to sell 5 units to break even. But what if the firm has a target operating income in mind? Okay, they don't want to break even, but they want to generate a profit of a certain amount. How do we calculate the number of units to be sold in order to achieve this target operating income, we repeat the same process as we did for this break-even calculation, but instead of assuming an operating profit of 0, we assume that the operating profit is going to be a positive number. If we repeat the same steps to the end, we can see that in order to achieve a particular target for your operating income, the number of units to be sold is given by the sum of your target operating income with the fixed cost, okay, and you divide that with your contribution margin per unit. Keeping up with the same example, let's say I want a target operating income of $30, okay. Now, how many units should be sold in order to achieve this operating income of 30 is given by, I'm going to sum the 30 with my fixed costs and then divide that with the contribution margin per unit. Okay. So in order to achieve a target operating income of $30, the firm has to produce and sell 8 units. Okay. If you go up to the table, you can see, you can have your confirmation here that the break even was at 5 units. And also when you produce and sell 8 units, you have an operating income of $30. We saw what a break-even point is and how to calculate that. But sometimes when a firm makes their budget, they want to see how far they are above the break-even point. Okay? This is known as margin of safety. Why the term margin of safety? It shows how safe they are from losing any money. Remember, once you go under the break-even point, you start losing money. So it shows how safe you are so that you're not in a position to lose any money. The margin of safety from a revenue standpoint is given by the difference between the budgeted revenue and the break-even revenue. Now, keeping up with the same numerical example, let's assume that our budget shows that we produce and sell 8 units. Okay, so our budgeted revenue would be the number of units, 8, multiplied by the selling price of each unit, which is 15. And from that, you subtract your break-even revenue. Okay, how much is your break-even revenue? The number of units you sell at break-even, which is 5, multiplied by, again, the price per unit. So the margin of safety in terms of revenue is $45. So what does this number represent? Your revenue is $45 above the break-even point or above a position where you could potentially lose money. Margin of safety can also be calculated as a percentage. You divide your margin of safety over your budgeted revenue. Okay, in this case, which is 8 units multiplied by the price, which is 15. Okay, that's your budgeted revenue. Okay, so margin of safety in this case is 37.5%. You can also calculate the margin of safety in terms of the number of units, which is the difference between the budgeted number of units and the break-even number of units. Okay, so that's 8 minus 5. So you're basically selling 3 units more than the break-even point. We've been doing our analysis so far by assuming certain numbers. Okay, we assumed that the fixed cost is $50. We assumed that the unit variable cost is 5. The unit price is $15. Okay, and we also assumed that we're producing and selling 8 units to do our calculations. But sometimes when these numbers are budgeted, a firm might want to do some kind of sensitivity analysis to see how their profitability is affected when these variables change. Okay, what if my fixed costs go up or down? What if my variable costs change? What if the demand for my product goes up or down, and so on? We'll keep the same numerical example and we'll try to do a sensitivity analysis on these numbers. So as you can see, I've kept the same numbers as earlier. Okay, what's the contribution margin per unit, which is the price per unit minus the unit variable cost? What's the operating income? It's the contribution margin per unit multiplied by the number of units sold minus the total fixed cost. Your operating income when you sell 8 units is $30, as we've seen earlier too, right? Now, let's say the firm is not too sure about 2 of these numbers mentioned in the table. One is the price at which they can sell the product, and also the demand for their product, which affects the number of units sold. Okay, and the firm wants to perform a sensitivity analysis to see how much their operating income could change if these two variables change. Okay, remember, any of these variables can change, right? Okay, right now we're just going to look at two of these variables and how that affects our operating income. Excel provides an easy way to do a two-way sensitivity table. Okay, you create a two-dimensional table. Let's say along the column, I want my price to change from 12, 13, and let's say my price could change anywhere between 12 to 23. And along the row, I'm going to change the number of units being sold. So far, I haven't specified any of that, right? I haven't specified that the row indicates my number of units sold and the column indicates my price per unit, okay? So at the intersection of this column and row, I'm going to link that to my operating income, okay? That's all you have to do. Now I select the entire table, okay? And I go to Data, What If Analysis, and Data Table, okay? Now it gives you two options, row input cell and column input cell. Row input cell wants you to educate Excel on what's the variable you want to change along your row. Okay. In our case, that's the number of units sold. So I'm going to link that cell. And through the column input cell, Excel wants to know what's the variable that's changing along the column. That's the price per unit. Okay. Once you click on OK, you can see that Excel has automatically calculated the operating income for several scenarios. Let's do some conditional formatting to visually see these numbers better. Okay, go to conditional formatting, color scales, and pick a scale that makes sense. I've selected a greenish tone for a higher positive operating income and red for lower or negative values and yellow for values in between. So how do we interpret this table? If the firm sells 5 units at $12 per unit, considering that the fixed cost of $50 and unit variable cost of $5 remain constant, the firm ends up with an operating income of -15. You can also see in this table some of the numbers we calculated earlier, right? If the firm sells 5 units at $15 per unit, we know that it breaks even. Okay. If the firm sells 8 units at $15 per unit, we can see that they make an operating profit of $30. We performed the sensitivity analysis on two variables, the price per unit and the number of units sold. In reality, you can perform a sensitivity analysis on any of the variables that can change, which can affect your operating income. Moving on to the final topic that's covered in this session, operating leverage. Degree of operating leverage is given by the ratio of contribution margin to the operating income. So how do we calculate that using the same numerical example as above? The degree of operating leverage is given by total contribution margin, which is the number of units sold, which is 8 multiplied by the contribution margin per unit. Okay. And then we divide that by the total operating income, which is $30. If a firm had absolutely no fixed costs, then the contribution margin would exactly be the same as the operating income. In that case, the degree of operating leverage would exactly be 1. But as a firm has more and more fixed costs, this number would start increasing from 1 and keep moving further up. So why is it important that we look at the operating leverage? As a firm, you always want to understand the risks involved in your business model. Okay, having a high level of fixed costs is very risky because when your demand falls, you might end up losing a lot of money. So a high degree of operating leverage shows that you have a higher proportion of fixed costs. Keep in mind that the degree of operating leverage changes at different levels of production. The operating leverage when you sell 8 units is different from the operating leverage when you sell 10 units as long as there are fixed costs. If a firm has no fixed costs, then the operating leverage would stay constant throughout all levels of production. In the next session, we are going to look at activity-based costing, or it's more commonly known as ABC costing. Thank you for watching. Cheers.